Good afternoon. This is Coach Mike. We're going to start talking about our focus group watch list and some potential trades. I hope you got your focus group spreadsheet, as this video will be kind of talking over that. Apple kind of exceeded a couple targets that I had on it, but still real close to a couple others. 101.80 is one target that I've had of interest that's just based off of this last move up, and then when we came and started establishing this trading channel, you can see on my chart. Now, even though you could probably get away on a pullback from it, and really I'd say you'd have to use that upper channel line for now as your stop, you could get away with like a 96 or 97 put. I think I'd rather suggest the September 20th $99 put, and like I said, anything that would go in the money according to the trade plan would be something that's okay. No further below a 96 put though. And let's confirm it first. Confirming it first would mean not right out of the gates on Monday, even if it started out red. Let's kind of watch it on Monday, and at the earliest look at an afternoon buy, but maybe even something for Tuesday. Next, Caterpillar CAT. A few weeks ago on the focus group spreadsheet, had the bounce trade on there. It made a really nice run. It got right into the gap fill from the earnings gap down. The earnings is kind of funny. They actually exceeded earnings tremendously. It was great for EPS, but they did have to change their guidance. They lowered their future guidance, and that's what really caused the decline. Now that it got up to that gap fill point and has begun to pull back, it kind of gives you a little trend line to go off of. I do think there's a potential at a puts play, even back down to the swing point. Remember those blue swing points you see on my chart? Those are from the weekly. I'll go over and show that real quick. There you go, the weekly. That's that W that it actually did retest, but it did so due to a change in the fundamentals, or at least a change in the projection of fundamentals. And I think it could be a little bit on the danger side. Now, I wouldn't mind taking an entry in it personally, but I would play the 105 put. I think it's a little bit safer. It gets you at least to this swing point here. In case it did bounce, okay, you'd be in the money. You wouldn't make much, but you'd make enough to notice that you should sell and sell it, not have to go, ooh, maybe I should have sold back there. It'll give you a chance to confirm it and still be not losing at least. But I'm kind of thinking overall you could at least see the swing point again. So it is a trade I have a lot of interest in. My suggestion of the September 20th 105 puts was simply because, let's face it, stocks fall faster than they go up. So, you still got just shy of a full month on those. The 105 put, it's got to drop $2. That's not much for a stock of this price. And I think the exit's pretty decent. Now, the risk is about 50% on it, because you'd have to stop out if it closed above that gap fill point, which would be a bit of a hit. But it's the reward side where I'm projecting around 180. If it were to get back into these lows again, that would make that risk worth it. One thing I would possibly suggest, especially if you are using TD Ameritrade and you've gone ahead and called and got that $1.50 per contract with no additional fee, the standard is $9.99 plus 75 cents, and some people negotiate that down, but they are still, to the best of my knowledge, I know somebody that called on Thursday and still got the $1.50 per contract with no additional fee. That means your contracts need to move 0.03 to break even. So you can buy just one contract and it costs you $3 to buy and sell round trip. With that being said, that's something that you could probably take just the one, and then as we get a little better confirmation, add to it if you wanted to do it that way. If I take this trade with my focus group money, that may be what I do personally. Gonna look over at CVX. CVX, there's some potential to either side. What I'm marking here is really an ascending triangle setup. See, it's got three tops right here on this horizontal line. You are making higher lows. A break above that top would be your indication for the 130 calls to this 131.65 target. I think if you wait, you're going to have to wait for the close above this horizontal line. Don't worry. That's where your higher probability trade is. It's not, ooh, let me buy it now just in case it goes there. Let it get there in case it just stays real tight. And you don't want theta to start kicking your butt. And don't just say, oh, I can enter the strangle. Let it break below or above. So on this calls play, let it get above your horizontal line. Look at your September 20th 130 calls. At that point, I think you can get them around 88. My estimated risk, which would be your close back below the point, it's going to be about 35 cents or so with a reward of 76. So it's kind of a 1 for 2, not the best risk to reward, but it's an ascending triangle, which is a high probability trading pattern. If you can get it right on the break, I don't think you're going to take as much risk as I'm estimating, even so long as you sold it real quick if it failed back below that line. The other play I've got here is with the 124.96 listed as support. That's your lowest close here. So it doesn't have anything to do with the ascending triangle. It has to do with this consolidation range. Because here on this double top, these last two top points, you had the higher low from your bottom. Well, if it were to just break this trend line, it'd have an M pattern. Well, an M pattern's target is that prior low point. That's not really worth trading for. But if we see continued weakness in like XOM, COP, whatnot, then a breakdown of that horizontal line could send us to a target of 116.54. So let's be watching for that. Let's be patient. Let it go sideways all at once. Set yourself some broker alerts on those two horizontal lines, and those will be the points where you go long or short accordingly. Going over here now to Facebook. Facebook, it's been a little weird, but Twitter and LinkedIn both had really great days Friday and good weeks overall last week. Facebook's not failing any supports, it's just not really moving. But in the long term, I still think that 83.70 target I've had is decent. But if you want to enter the new trade, I think you need to let it break above 75.19. Not just like it did the other day, but it's got to hold above that. I wouldn't let it get too far above it, but it'd be one of the risky chances you got to take. I'd be looking to buy no greater than 75.50 once it did break that line, and probably move out to the October 18th $80 calls. Probably get those around $1.55, $1.56. If we get right at the break, if it fails that, we'll probably be risking about 20 cents on the contract. But that big move there could give us about 229, which is a phenomenal risk to reward. I wouldn't jump the gun on this. Please don't jump the gun. Let me zoom it in a little bit and you can see it a little better. Don't jump the gun on it. Wait for the break. And even though it broke it the other day, and even if it goes a little slow through the week, that 75.19 is also the weekly swing high. So even though we broke it on a daily, it was the weekly point. And if it goes a little slow but closes the week above there, then we'll definitely have some assurance that we could see some topside. As far as Facebook goes, on our 60-minute chart, let me change it over to that here real quick. We actually had a gap here that Friday's first candle. I mean, you talk about a scary candle. Friday dipped real hard and fast, but it filled that gap, which now just gives us this other swing high right here. But all in all, where did it close at? Still above and held above a prior swing high here. Now, we are trapped by the last swing low, and if we break above that point, I think you at least got to play, 75.01, but I think that would be the gap fill play. I think we're going to see the momentum, the sector-based momentum from Twitter and LinkedIn help out with Facebook. So keep an eye on your shorter-term chart, your 60-minute chart as well, to assist you. Now we're going to go over and take a look at First Solar, FSLR. First Solar still hanging out at that resistance point. Again, if you bought the W play we had on our spreadsheet a few weeks back, It's really slowly trickling. If it doesn't make a break on Monday, I would sell it. You're close enough that the time is going to hurt you anyway. You do have from these tops, you see this down channel, 1, 2, getting in, almost had a hit there, almost a hit here. We got to break that before we look at anything good. I'd really stay away from this one for right now, personally. May even look for a puts trade, but we need a little better confirmation before we did that. One red candle's not good enough. Let's go over and look at GLD. We have that horizontal channel. We've talked about it for months now. We got real close to the bottom line of that horizontal channel the other day, and kind of thinking it's to that point where you could re-enter that strangle, just like we have on the spreadsheet, 2 to 3 months out. I personally like the 126 calls, the 122 puts, and if you want to wait for it to get a little midway in that channel, that's fine, but sometimes it doesn't. Sometimes it gaps straight through that channel. So pretty much this channel is what we've identified as kind of the safe zone to play that strangle 2 to 3 months out, and then trade the winner, and it always seems to come back within that channel well before the expirations, so there's no big deal there. GS, Goldman Sachs. Couple trades listed on here. I really don't like Friday's candle. I liked it for most of Friday on the daily chart if it would have stayed above 176, which is the 50% line for our target area for our September 180 calls. But let's face it, it's got a very big upper wick, and if it pulls back from this area, that would be a really pretty evening star, and we would probably need to be trading the 170 puts for September, at least down to this bottom area again. After the double top, we would anticipate a double bottom, but we would want to keep an eye on our 50% line. I wouldn't sell my calls right away early in the day, but if it went red, I would take puts. That's just how I would look to trade that. If it confirmed that evening star, then probably Tuesday I would look to exit my calls. And there's another puts play on here, kind of based on these overall pattern formations, and you can see it a little better from the weekly chart, so I'll go over there real quick. And you can see how we've kind of topped out on this prior high point. And that being said, could see a little bit of weakness come, especially after the sequence we had already had. I think the fundamentals are good enough that it wouldn't surprise me if Goldman Sachs went up still from here. But it is going to be important that we watch for what is happening here as well, because if it did pull back, we would have a lower high. And overall, we could also look at playing a little farther out, maybe even like a 155 put and playing it, kind of small and building into it later on. And if we break and hold above that 176, those of you that aren't in the 180 calls, I think that could be your entry. So it would have to break and close above the 186. I would even say let it get above the 177.48, and then you got a higher high. If you're not comfortable with September's at that point, go ahead and look at your October monthlies. I'm going to switch my chart over again. We're going to go over to Lockheed Martin's daily chart. Lockheed Martin came just shy of those 177 area that I was targeting. And by just shy, I mean pretty darn close. I didn't like the last couple days' candles, but I do still recognize that Fibonacci's extensions have been a very accurate trading system for Lockheed Martin for several years now. So it could budge up there, maybe have another good candle that gets there. If it does pull back from here, though, I would start looking at your 170 calls for September. I don't think it's going to be anything that hurts the stock long term, but I think it could bring it down to this 167.29 or so, or at least this trend line, wherever that price might be. And that's what I'd look to play for. But you'd want to take the September 170 puts. I personally don't see a call straight in this right now. Let's go ahead and look at UPS. UPS got right into that area that I had feared. I actually thought it'd get up to 99.79, but it weakened out even quicker. you do got a little trend line for anybody that took that dangerous calls play, which probably going to tell you it could pull back a little bit more. It did fill this gap over here on Friday, which could be a bullish argument, but I don't see any calls trade in this. There was a big change fundamentally. Looks to me like a dead cat bounce. Even if it went up more, it could just still has to break that 50% line. I think you could at least see the double bottom again. Actually, I think you could see 94.27. But by the time that puts play is going to be validated for you, which would really be the break below this trend line, I think that the risk would outweigh the reward. So it's not something that I'd be interested in playing. Finally, Visa, ticker V. Yeah, I said in last week's video, actually the last 2 weeks' video, even when we called it off this bottom, that I didn't want to trade it because after that earnings, I didn't think it would break this 50% line. And here we got it, it's kind of sitting there, not really confirmed a pullback from it, but it also hasn't broken it. You could very easily at this point either continue the trade up to about 225 or drop to about 201, which could make it a halfway decent strangle trade, but I think that it'd be better rather than strangling it to get at least a confirmation. Friday's doji candle isn't a confirmation. Thursday's hit the 50% line and went red for the day isn't a confirmation. But that doji candle, typically an indicator for watch my next candle, doesn't say it's reversing. It just says, hey, watch my next candle. And if it breaks that 50% line, you could play for continuation to the 225.65. If it continues pulling back, I would at least credit this bottom area here for a double bottom, but I think you would be looking more for around 201.33. This is Coach Mike going over the focus group charts and with the correlations between the charts and my spreadsheet that I sent you. We had some really nice run-ups, folks, in the last couple weeks since that market bottom. Really nice run-ups. It's not hard to fathom that you could have a little bit of a pullback with the run-ups we've had. Usually I don't do this in my focus group video, but I'm going to go to the SPX chart. My SPX daily. It is not uncommon in an up run. Let's look at just over the past year, some other times the market went up. A nice solid up run, nice pullback. And then we stopped making those nice patterns we had for the time leading into there, and we get into this consolidation. And it's not until it makes a break up or down from the consolidation ranges that you find your higher probability trades. Let's not force anything until we get a development in market direction. Those of you that have been here a while, in these consolidation times, a lot of them swing trades can be pretty difficult. Even the day trades can. Your longer term stuff, you can be okay in consolidation. You can be okay being willing to give a little back for the potential to make more. But we have to identify what it's going to do. Is it going to do like it did last September, where it just went straight up and straight down but made a higher low? Or are we going to do like we've done every time since, where we run up about the same amount of time that we've run up since the last bottom and started in a consolidation pattern? And that's something we simply do not know yet. Never be afraid to buy a stock on a positive move from support. Never be afraid to short or play puts on a pullback from resistance or a failure of support. But before we convince ourselves of trades going into this week, we need to be able to identify if we're getting continuation or consolidation or a pullback. A pullback would be healthy. On an up move like this, we need a pullback to establish our current trending channel. You don't just lie on the long-term stuff and wait 3 months at a time for it to come back to it. It's nice to get these shorter-term channels to help you trend off of that. So that's what we got to look for. So, at this point in time, I would kind of like it to pull back. And I don't even think I would want to short on the pullback. Because these times in the past where we got the nice market pullbacks, when you think it's going to pull back like it did back here a year ago, what does it do? It ends up just giving you a couple days consolidation, and it doesn't do much. We need to wait for the times to see if it'll establish some bit of consolidation, and if not, play the continuation. To some, that seems like you're chasing it because it means you won't be getting the lowest buy prices for the puts. But it also means you'll have a higher probability at making winning trades, and that's what we're going to watch for. So, good luck to everybody this week. Join me in the chat room as much as possible, and let's see what kind of money we can squeeze out of this turnip this week.